Welcome to the third installment of the Momentum Investments Global Citizen Masterclass series. I'm thrilled to kick off today's session. They say the only thing certain in life is death and taxes. Well, today we are focusing on the latter with a little less doom and gloom. We hope this session gives you deeper insights to formulate a solid advice framework for your global citizen clients. Some housekeeping: we've applied CPD points because we know nothing says fun like a certificate of completion. So stay tuned and don't miss out on your points. You've earned them. Please watch the entire session and ensure your ID number is logged in the CPD section so we can verify your attendance. The sending of CPD certificates is now automated and they'll be emailed to you as soon as you've watched the entire session. Please also feel free to ask questions in the Q&A section. Our speakers will either answer them live or get back to you after the event. You'll also find more information about our speakers under the Speaker tab on the top menu bar or by scrolling down where you can download the PDF presentations. Please engage with our speakers and enjoy the event. To kick things off, Sharon Haman and Misha Badassi, legal advisors at Momentum Distribution Services, will break down the crucial global tax trends and consequences that form a key part of today's discussion.
Good day and thank you for joining us, and thank you Fransha for the introduction. I've been privileged to be part of the global citizen journey for the last 18 months, and it has definitely sensitized me and our team of legal advisors to the factors that we have to consider when dealing with clients on an international basis with investments and their global planning.
Sharon, I can definitely attest to that. Over the last couple of years, I have personally witnessed an increase in the number of global citizens we encounter, and as a result have been involved with many clients with international unique challenges. It is a constant learning school and a specific focus area for us to upskill ourselves and to build a network of trusted support and be the best support to our financial advisors and their clients.
Yes, you can say that again, learning school indeed, which is probably one of the root causes for this initiative. A common message throughout the series has been the need to form and cultivate a circle of trusted partners that can be relied upon when needed, from product providers, legal advisors, fiduciary specialists, tax specialists, to name a few. It is impossible to have all the skills, as we know, and the expertise in one person to advise on all these matters in all jurisdictions. Teamwork is definitely dream work when planning for the global citizen. Misha, as you mentioned, there has been a serious upswing in the number of global citizens we are in contact with at the moment. So based on your recent experience, what would you say is your most common jurisdictions that you are encountering?
The most common by far is the UK, Australia, and the US. However, as a team, we have seen this list grow over time, with common questions and scenarios reaching places like the UAE, Canada, Netherlands, and Portugal, to name but a few. There is often a curveball to force us back to the drawing board.
You can say that again, Misha. My most recent interaction was on a client living in Ethiopia, so never a dull moment. The focus of today's Global Citizen is global tax trends, with the intention to give a high-level overview of some of the most relevant current legislative developments that are taking place across the globe that may impact our current and future advice given to these global clients. It is a competitive market where knowledge is probably our highest commodity, and we hope that after today you leave with a greater sense of comfort, that you can perhaps interact with those clients a bit more meaningful and feeling that you've got a bit of an edge.
Definitely. I, for one, was surprised to learn of some of the changes and anticipated developments, and it also highlighted the fact that we do not know what we do not know. It highlights the challenges we face to stay abreast with the latest news, the development, and its impact. I am actually on the mailing list of various international service providers, and I struggle to determine what's important and relevant in our world, what to read, what to keep and what to delete. With limited time, it is not always doable to work through all the detail, and many land up in the to read one day inbox, which I know, Sharon, you share my sentiments as well. One of my biggest struggles is to successfully navigate between all the information and to actually decide what is relevant.
I feel the same. It's a pain that I think all of us have these days with information overload, and I don't think there's an easy recipe to actually extract the right information that we need. We would not need events like this if we were able to navigate our way through the information, and that is why I keep on harping on the partnerships that we need to establish to help us to find our way through the maze of all this information. For me, I see each client story as a puzzle. So you get your client with the 100 pieces. It's fairly simple, it's easy, it doesn't take too much time. And then we have the 5,000 piece client, where we really have to struggle to build that puzzle. And each puzzle piece we need to decipher and find before we can actually build that client's big end result picture, which is this perfect picture of the Eiffel Tower, whatever you've been spending your time on and wherever you feel that you want to go. So let's be honest, nobody will start building a puzzle if they know that there are key pieces missing. And the same applies when we're doing financial planning for a client. So like the saying goes, how do you eat an elephant? Little bites at a time. And the same rings true for financial planning on an international scale. One puzzle piece at a time. It keeps you focused. It guides you to seek the right information, and it's easier to navigate. So over the course of the Global Citizen webinars, we have touched on most of the key puzzle pieces required to build that complete client picture. And it's within this framework that we are seeing some of these changes taking place. Just to recap, from my point of view, the most important puzzle pieces that I tend to focus on when you guys send me those curveball Global Citizen clients scenarios is the following. Probably always as a starting point is to ask tax residency. Where is this person a tax resident? But even expanding from that, where are the beneficiaries tax residents? Because it really impacts where the story and what the puzzle looks like. Domicile and habitual residence is also important, and we'll see a bit later why we say that. Where the assets are located, so the ever important situs that everybody always talks about. What those assets are, what investment products were used, what's the nature of those products. Applicable succession laws, wills and probate, looking at the will structure and the trust structures and companies that the clients have. So all those elements together, if you start populating them, it's probably the core pieces of that puzzle.
Sharon, I particularly remember the session where you discussed residency with Madeleine Schubert, and she's one of our regular guests during the series. When confronted with the client story, it is also my first question that I actually ask. I would dig a bit deeper. I would ask, how did he actually become a tax resident of that country? And also, what are the future plans in respect of moving to another country? Many countries use residency as a right to tax on worldwide income. In South Africa, we use, as you know, the ordinarily resident test or the physical presence test to determine that tax residency. If a person is no longer a South African tax resident, they will no longer be liable to pay tax in South Africa on their worldwide income. However, source-based tax rules tell us that we need to apply them to all South African sourced income that remain taxable in South Africa. As we have learned, a person can only exit tax residency in the same way that they actually entered the system. So if you were a tax resident due to you being ordinarily resident, you will not be able to exit the South African tax system by breaking the physical presence test rules. You can only then exit if you are no longer ordinarily resident and vice versa. It's therefore, I think, very important to understand how the person entered the system and exactly what their future plans are.
I agree, and we often forget that we don't even ask how they came in, because we tend to forget that people are migrating across the world all the time. My research shows that many countries use similar tests to determine tax residency, and we often take it for granted and assume everybody's got the same basis, the same rules, the same tests to apply. I was recently reminded that the UK uses domicile as one of the key features to determine their right to tax. For income tax purposes, they use specific non-dom rules. Yeah, non-dom, you've heard it. Applicable to residents that are not domiciled in the UK. And for inheritance tax purposes, their right to tax is also based on domicile. This is one area where major changes are being expected in April next year. And as the UK is, as you mentioned, one of our most prominent jurisdictions we work with, I've asked Corlia van der Merwe, one of our legal advisors in Gauteng, to share the details with us. Corlia, over to you.
Thanks, Sharon and Misha, and hello everyone. Thank you for taking the time to listen to us today. I've been tasked with sharing the highlights of the proposed UK tax changes with you. Change. In the words of Socrates, the secret to change is to focus all your energy, not on fighting the old, but on building the new. New and revised financial plans may be necessary after the implementation of what I'm about to share with you today. Those of us with UK resident clients will have our work cut out for us during the months to come, that's for sure. It's surely a daunting task to stay on top of it all the time, and in my opinion, virtually impossible. So before I even start, I have to echo Sharon's sentiment that you cannot build this puzzle on your own, as you're bound to miss some important pieces that will spoil the whole picture. So without any further ado, let's get to it. The UK tax system is based on residence and domicile status of a person. If a person is a resident in the UK, they will be liable for tax in the UK on their worldwide income. A non-resident will only pay tax in the UK on UK-sourced income. So the rules being very similar to South Africa. The UK has various tests to determine whether someone is a resident. In general, a resident is someone who does not meet the requirements to be a non-resident, and who is in the UK for at least 183 days during the tax year, or has their home in the UK and spent at least 91 consecutive days, of which 30 days were in the tax year concerned, at their home. There are other tests concerned with work days, etc., but it's beyond the scope of today's session. A non-resident is someone who has been a non-resident for the last 3 years and did not spend more than 45 days during any tax year in the UK. If a person is not conclusively a resident or a non-resident, the UK has sufficient ties tests that are applied to determine if they should be treated as a resident or a non-resident during a given tax year. The test can be extensive, as it determines whether the person has certain predetermined ties with the UK, and the more ties the person has, the less number of days they have to spend in the UK to be seen as a tax resident for that tax year. Therefore, the global citizen client should consult with UK tax specialists where they are uncertain of whether they will be a tax resident or not. It's a complex area that you should not attempt to interpret without support. The UK has a special tax dispensation applicable to UK residents that are not domiciled in the UK, commonly referred to as non-dom. This is referred to as the remittance basis of taxation, where the resident taxpayer will not be liable for tax on their foreign income and gains in the UK, as long as it's not remitted to the UK. As soon as it's remitted into the UK, it will come into the UK tax net and be subject to tax in the UK. So in terms of English law, domicile refers to the country that a person views as their permanent home, even if they're not a resident in that country at that time. Therefore, you can be a resident in one country and domiciled in another. Domicile is either based on origin, choice, or dependents. In addition, a person who has been a resident in the UK for 15 out of 20 preceding years, immediately preceding the tax year in question, will be deemed to be domiciled in the UK. We will not be spending time on different domiciles today, that's for another day. As a result of domicile rules, the remittance system has allowed for effective tax planning strategies where people living and working in the UK successfully shield offshore investment income and gain from UK tax. And where the investments are held in tax-neutral countries, they could successfully avoid paying tax altogether. As you may know or not know, the UK also had the general elections in July this year, where the Conservative Party was replaced by the Labour Party. So why is this relevant? Well, in spring 2024 budget, the Conservatives share their proposed changes to the tax system, which would be phasing out non-dom remittance tax system. And at the time, the Labour Party actually agreed with the principle, but mentioned that they saw loopholes that they would close if they elected. During their campaign, they stated that they would do away with non-dom system and replace it with a more efficient tax system, and also in the use of offshore trust to avoid inheritance tax. So with the elections over and done with, and the Labour Party winning the elections, new information on the proposed changes has been shared in media statements and with positioning papers being published, along with a lot of consultations. At this time, no legislation has been drafted, but if they keep to their timeline, the system will be implemented around about the 6th of April 2025. As things stand, the changes can be summarized as follows. A new tax regime will be introduced, purely based on residency, that is simpler to understand and apply, doing away with domicile altogether. The tax system is intended to be internationally competitive and focus on attracting the best talent and investing for the UK, whilst ensuring that all people living in the UK permanently pays the same tax. It will introduce a new 4-year foreign income and gain system, as was proposed by the previous government. It will replace remittance basis of taxation that applies at the moment. In essence, the new 4-year system will apply to individuals who were not UK residents during the preceding 10 consecutive years, and they will qualify for this new tax regime during the first 4 years of UK tax residency. It is proposed that the taxpayer may opt in the new regime annually. If selected, the foreign income and gains earned during the year will be exempt from UK tax, even if it's remitted to the UK. If a person elects the system for a tax year, they will forfeit some of their personal income tax allowances and capital gains tax annual exemptions. It is probably something that will influence their decision-making each year. If selected, foreign income and gain distributions from non-UK resident trusts will not be taxable in the UK during this period. The option will only be available for the first 4 years of residency. Thereafter, it will fall away, and the person will be liable for UK tax on worldwide income. Changes to inheritance tax is also being considered. So currently, the right to levy inheritance tax is based on domicile. If a person is domiciled in the UK, they are liable to pay inheritance tax on their worldwide assets. If not, they will only be liable on assets situated in the UK. CITES. In terms of the new proposed system, where a person has been resident in the UK for 10 years, they would be liable for inheritance tax on their worldwide assets in the UK, which will continue to apply for 10 years after they leave the UK. This can have far-reaching implications for people leaving the UK and taking up residence in another country where no double estate duty agreements exist. It can easily result in assets being subject to inheritance tax, estate duty, in more than one country without any double taxation relief. tax changes are also being investigated and proposed for trusts. And the motivator, a move towards tax certainty and less administration. The intention is to tax a UK resident settler on UK and foreign trust income and gains, unless of course a above 4-year system is selected, and not taxing distributions made by trustees, therefore taxing the income and gains before it is distributed to beneficiaries, irrespective of whether it is distributed or not. Another major change that is being considered is for foreign assets held by certain offshore trusts to be included in worldwide assets subject to inheritance tax. It is the Labour Party's intention to ensure that nobody living in the UK permanently will avoid paying UK tax on their worldwide income other than the new regime being introduced, and inheritance tax on their worldwide assets, whether in their own name or that of a trust. There's transitional proposals made to accommodate those that have been using the remittance basis of taxation in the past. And they are also considering how changes can be introduced to allow for appropriate adjustments to existing trust arrangements. However, at this stage, no details available. So for our UK resident clients, one thing is clear: a wave of change is coming. And we can expect some discomfort as a result of this. But together, we can ensure that they remain informed and they have access to the necessary specialists to assist them in making the right decisions to keep their affairs in order. Thank you. Back to you, Sharon.
Thank you, Corlia. That was a mouthful. And listening to you, it's easy to think that this is not relevant to our clients, but it can be, and we should actively seek out our clients that we know might be impacted on it. And if we don't know, we have to really apply ourselves because they are there. For clients that have been living in the UK for a number of years, but have benefited from the non-dom rules, keeping their foreign income and their gains outside of the UK tax loop, things are about to change. Okay, if we look at an example, we have this client who's living and working in the UK. He's been there for 10 years, so he's not a deemed domiciled yet, and he is still domiciled in South Africa because he was born in South Africa, so it's his domicile of origin. But he is no longer ordinarily resident in South Africa, so he's not a tax resident anymore. He has accumulated some wealth over the years and he holds investments in Guernsey and in South Africa. As he qualifies for the remittance basis of taxation at this moment, as it stands today, he does not pay tax on the investment returns and gains that he realized in Guernsey or that he realized in South Africa. So from a UK point of view, the income that he's generating from those investments are totally free from UK tax. When the new legislation comes in, this might change because obviously this client has been in the UK for longer than the 4 years that Corlia referred to, and meaning that investment income in both Guernsey and South Africa might now become taxable in the UK. We must also remember he's not a tax resident in South Africa, so he is also paying tax on that income in South Africa that is realized in South Africa because of the source-based rules we mentioned before. So if we go a bit further, Corlia mentioned that they're also looking at changing rules around trusts. If we assume these investments are held in an offshore trust, if the protection that we are relying on at the moment in respect of those trusts might also fall away. As we heard, they might bring the income that is earned in those trusts into the UK tax net, and they might bring it into his estate for inheritance tax purposes.
Sharon, this example brings potential consequences home, and it is daunting to say the least that as changes can result in the puzzle pieces no longer fitting into the overall bigger picture. I know our general rule is not to act on legislative changes until we are actually sure about all the finer details, but I think we cannot ignore it also at our own peril. I see a potential consequence for double taxation. Luckily, we do have a very well entrenched double taxation agreement in place with the UK, and it will definitely assist those clients holding assets in South Africa. Our tax legislation also contains protection against double taxation in the form of Section 6 Quad, which provides for tax rebates where taxes were already paid in another country. Once again, I have to reiterate that it is vital for advisors to partner with us, with the right specialists, to guide them through this uncertain terrain.
I have to agree. The dream team always comes to mind, doesn't it? Just on changes, and another popular jurisdiction that we often look at is Portugal. Obviously, over time, from a South African point of view, we've seen an uptake in the aggressive golden visa offering that Portugal has offered, where people obviously buy the second or third property in Portugal to qualify for the residency visa. So as some people say, a plan B, if something on the economic front goes wrong, they've got somewhere else to go and live. Many clients even started to live there as a result, however retaining their South African tax residency due to being ordinarily resident in South Africa. Now, just to take a step back, Portugal, right after the economic crisis in 2008, introduced the non-habitual resident tax regime, which was basically introduced to attract a lot of foreign investment, or some foreign investment, and obviously also some skills. It applied to people who relocated to Portugal during the first 10 years of being there. So the only requirement was that they were not allowed to have been living there for the last 5 years. So it provides for tax incentives that were very attractive, providing clients or people that move there with very attractive taxation on their pensions. So obviously trying to attract older clients that are possibly bringing some money into the country. Also giving preferential tax rates to certain types of employment, especially that I read about was doctors and teachers, so trying to build on their skills. And then also providing for a tax exemption on foreign investment income that is subject to tax in the other countries. So a bit different than what we're seeing with the remittance basis that we spoke about for the UK, where in this case they say if you already pay tax where the investment is, you won't pay tax in Portugal. So providing some relief for the clients. However, last year the government decided they're going to abolish this from the 1st of January this year. And it no longer applies for anybody that moves to Portugal or lives there from this year onwards. They had some transitional rules that applied, saying that if you could prove that you were going to move to Portugal and the plans were being made between or during 2023, that they will still afford you the benefits, but otherwise, if you move there after the 1st of January, no more tax benefits for you.
I read about these changes as I also consulted with the client that was planning to relocate to Portugal. And even though the move was not solely motivated for tax purposes, it was an important puzzle piece for that particular client in making his overall final decision. In my research, I came across an article published in July by Reuters stating that the Portuguese government is actually planning to reintroduce some of the tax changes or tax breaks for these foreign residents to actually attract skilled workers. It seems like the new government has also been voted into power in March of this year, and they are motivating for the reinstatement of some of these tax benefits, especially those linked to specialized employment to attract these skills. Once again, confirming the narrative that we've always spoken about, that the international landscapes is in constant change. When clients are considering moving abroad, it is worthwhile for them to take note of these non-resident tax regimes, as many countries offer them. Some other countries that are also popular among South Africans include Italy, Greece and Switzerland, to also name a few.
I think important to note from what we've now seen with what Corlia said and what you said, and especially the Portugal story, in a matter of a couple of months, one government being replaced by another, and all of a sudden the tax system is on its head. And just again, for me, underpinning that things are changing the whole time, and we can't even assume that something that we researched last year is still relevant this time when we got the same type of facts. We have to go back and research all the time. I'm also starting to see a bit of a trend where the balance between attracting foreign investment in talent versus keeping the country's own citizens and residents content that the system is fair has become a bit of a balancing act, because we are seeing that there's a definite resistance for people to welcome foreigners into their country, because it's starting to feel like they say, you're taking our jobs and you are benefiting from tax breaks that we are not benefiting from. And that is definitely causing a shift, it seems, in some of these tax systems. And as Corlia mentioned, the Labour Party said, if somebody lives in the UK, everybody should be paying the same taxes. So you shouldn't really have this discrepancy between a non-dom person and an actual citizen or somebody, a tax resident that's living there. As a last point of interest today, I want to steer our discussion towards trusts. The reason being, many of our clients obviously use trusts locally and internationally. And as Corlia also explained, the UK is taking a much tougher stance, or planning to, on offshore trusts. The motivation being that countries are missing out on potential taxes where assets and investments are housed in trusts. We have seen it in our own legislation. The Taxation Laws Amendment Act last year introduced tax changes impacting local trusts with foreign beneficiaries, so aligning the global trend with keeping taxes within the country. Up until now, the taxation of trusts for us in South Africa was identical, irrespective of whether the beneficiary was a resident or a non-resident. Without going into the detail of all the tax rules, and also at this stage I would like to mention that for today's purposes we are not going to focus on deeming and provisions and attribution rules, it is worth noting that Section 25B of the income tax was amended. Now this section is commonly referred to as the conduit principle, meaning that where income and capital gains are distributed to the beneficiary, it basically works like a conduit. So in the year that the income or gain is realized, it flows through to the beneficiary and it's taxed in the beneficiary's hands. So it really is not taxed in the trust. Looking at the picture, you would see it just flow through the trust vehicle into the beneficiary's hands, and they will then account for the income or the capital gains and pay tax for it in their capacity. For resident beneficiaries, the tax would still be paid in South Africa. However, non-resident beneficiaries resulted in the funds leaving South Africa, and as that beneficiary is not a South African tax resident, the tax will be lost for South Africa. And so the change was introduced. So where income is being vested in a non-resident beneficiary, the rule now states that it will be taxed in the trust, first and foremost, and then the beneficiary will receive it after tax. Meaning that the income will be subject to the tax rate of the trust, which is 45%, and then the beneficiary will receive the income and no further tax will be due in South Africa, but keeping in mind this is a non-resident in South Africa, so he or she is a tax resident somewhere else. So leaving them to sort out double taxation rules on that. I just want to say something on the double taxation in this case, because an interesting point is most double taxation agreements are aimed to prevent an individual, the same individual, from paying tax twice. In this situation, we've got two taxpayers. We've got the trust being taxed in South Africa, and we've got the individual that's now going to be taxed in his country of residence. So I'm actually not sure that the double taxation agreement will provide relief, because to separate taxpayers, there is no double taxation if you look at how the DTAs are written. So interesting point.
I think similar rules exist actually, Sharon, in Australia as well. So where an Australian trust beneficiary is not an Australian tax resident, at the end of that tax year in which they receive that benefit from an Australian trust, that amount will be actually subject to tax in the hands of the trustee and not in the hands of the beneficiary. So this is generally not the final tax, as the non-resident beneficiary will have to still complete the tax return as the income is from an Australian source. And if that beneficiary is liable for tax on the income paid, a tax credit will be enjoyed for the taxes paid by the trustee on behalf of that trust. The process ensures that the tax is retained in Australia. So it's worthy to mention that there are different types of trusts in Australia that are taxed differently, where some tax types have to withhold taxes before vesting it in the actual beneficiary. Once again, it's beyond the scope of today's discussion, and we won't go into that much detail. Our purpose today is to alert you to the setting up of the local and or the offshore trust, and it may not have all the same tax consequences, and in some instances may lose the desired application altogether, where, for example, the beneficiaries move abroad or where there may be tax changes that are introduced. With global migration trends, we are seeing more clients being impacted by these changes, with children living all across the world. And it is for this reason that we initially said one of the key puzzle pieces in a client's financial plan involves the future plan of the actual beneficiaries as well.
That's a very valid point, and something I feel South Africans are not always so successful in doing. We don't generally do multi-generational planning that well. Not that we don't have that intention. I think most clients that build up wealth has got the intention to pass it on to the next generation, but we don't always think about the details and what the implications could be if certain things happen whilst putting those plans in place. A child moving to another country can definitely destroy the best laid plans. As we have heard in some of our previous global citizen events, some countries do not look favorably upon endowment policy proceeds. They tax it. Other countries are not in favor of offshore trusts, and some of them don't even recognize the existence of the trust, so they look right through the existence of that trust. So where a client or beneficiary is planning an international move, it is as simple as taking note where they're going, calling that partner in your trusted circle to find the right information, and to look at what the impact will be. We have to review the client's financial plan on a regular basis, and we have to make sure that if changes, especially big changes like moving or a child moving, takes place, we have to make sure that we take into consideration what the impact is. In some instances, there might not be a way to fix or avoid consequences, but it is sometimes as easy as changing a beneficiary nomination or vesting assets in a beneficiary to exit them from a trust structure, each obviously coming with their own consequences. But at least if a client makes an informed decision, they can anticipate what the consequences are and we can plan for it. So the ultimate picture still remaining intact, be it a bit different. Misha, thank you very much for being part of our session today and for sharing your experiences with us. It's very valuable. And I would also like to thank Corlia for her valuable input and food for thought. If the proposed changes are ready for implementation in April next year, we will surely be providing you with more details and its potential impact on our global citizen clients. So please watch this space. I will now hand over to our MWI specialists, who will remind you just how robust and adaptable our product offering is, providing solutions for most, if not all, your clients' investment needs. And in closing, I would like to invite you to include us at Momentum in your circle of trusted partners. We are here to assist you to find the answers and solutions to the most daunting financial planning conundrums, helping you to build the picture-perfect puzzle for each client. At Momentum, our purpose is to build and protect our clients' financial dreams, a realistic and attainable goal, especially when we work together. Thank you.
Thank you, Sharon, Misha, and Koya. Be on the lookout for videos where we celebrate some of the exceptional IFA women and their contribution to the industry. I am now joined by Hannes and Maria Silvier, who are regional managers at Momentum Wealth International. Today, we're diving into the offshore structuring world, because who doesn't love navigating a financial treasure map? Gentlemen, welcome.
Thank you.
Welcome to
Thank you.
today's session. Hannes, after hearing the earlier presentations, what was very clear to me is that choosing the right offshore provider can be extremely daunting and challenging. What are your thoughts?
Francois, a very good starting point. I think one way of looking at it is to ask yourself, what are the main planning objectives that you would like as a client or a financial planner to take shape in your financial plan? Because often it's a challenge to reconcile certain objectives. For example, planning for taxation during the lifetime of the client versus estate planning in the event of the death of the client. So you end up with certain challenges, for example, reconciling income tax with succession planning or estate duty. That's the first point. The second point is that we must remember that financial products were mainly built 10, 15 years ago for South Africans investing offshore. It means that the focus is not necessarily on multi-jurisdictional aspects of products. It's not necessarily focusing on how should you plan for the inheritance of your product when your children have immigrated. So, starting point.
Hannes, let me just stop you there. It's an interesting point about how the industry has completely changed in the manner of 10 to 15 years, talking about immigration. But Marius, let me ask you, do you think the products that was built 15 and 20 years ago are still relevant for an ever-evolving financial landscape, specifically if you look at immigration?
Yes, Francois, definitely. Without a doubt, I think they still are very relevant because most of the investors that we deal with are South African investors.
Hannes, and you interrupted. Please continue.
Ultimately, I think the two test questions, or call it asset test or whatever you want to do, is does my selected product provide for appropriate estate planning, appropriate tax planning, and does the product provide for multi-jurisdictional scenarios?
So flexibility.
Flexibility, yes. That's one of the important aspects when considering or deciding on or selecting an offshore product provider.
Thanks, Hannes. Marius, can you briefly recap the product offering from Momentum Wealth International and maybe touch on some of these flexibility points that Hannes raised and how important that flexibility points are?
Sure. On screen, you will see that we have two products, but I'd like to explain it as three products in essence. So the first one is what we call our international investment option, and that is our LISP product that's domiciled in Guernsey. So it mustn't be confused with SA registered LISPs. This is a pure LISP product registered and domiciled in Guernsey, and the minimum investment there is $25,000. You will see it allows for single and multiple ownership. And then we have the endowment. Now the endowment comes in two variations. So we have the sinking fund, or what we call a capital redemption bond, and we also have the life endowment, or what we like to call a life insurance bond. Both of those endowments have a minimum investment of $18,000. So really, if a client or a financial advisor partners with Momentum Wealth International, there's a lot of choice in terms of implementing their investments through Momentum Wealth International.
Is it not overly complex? I mean, let me ask you, is it absolutely necessary to offer both a capital redemption bond or a sinking fund and a life insurance bond?
Well, we get that question quite a lot, and it's one that pops up all the time. So you have both variations of the endowment. Which ones should I use? So let me maybe start by saying what is similar about them, and then I'll share with you what's different about them. So both endowments are governed by the Long-Term Insurance Act, so it does have a 5-year restriction period. The 120% rule applies. On both products, you can have a single owner or a multiple ownership structure. And you can take interest-free loans because we have the 100 policy structure on both of these endowments.
So typically, when you look at an endowment, the one thing that you cannot get away from is the sense of liquidity.
Correct.
There isn't liquidity.
Yes.
Can you quickly touch on the 100 underlying policies and how does that work?
Sure. So typically on your local endowments, an endowment usually only affords you one interest-free loan and one withdrawal. What we've done on the international structure is where you have this 100 policies underneath. So it just creates a lot more liquidity for the client, so they're not stuck in this one interest-free loan, one endowment situation. And those are both on any variation of the endowment that you do use. What makes them different is basically three things. The first thing is a sinking fund by definition doesn't have a life assured attached to it, where a life insurance bond will always have lives assured attached to the contract. So that's very important. The second important thing is that there is no creditor protection. Okay, so by definition, in terms of the Long-Term Insurance Act, there's a section called Section 63. It talks to what affords an endowment creditor protection. And one of those things is you need lives assured on the contract. So as I just mentioned, sinking funds, not only momentums, all sinking funds in the industry won't qualify for creditor protection because there's no life assured attached to the contract. But the life assurance bond, because it has lives assured attached to it, will qualify for creditor protection, together with the other few things that you need to have for it to qualify. Then, of course, the other thing is that on a sinking fund, you can only nominate a beneficiary of ownership, or what we refer to as a successor contract owner, where on a life insurance bond, it gives you more flexibility. You can choose, do I want a successor contract owner or beneficiary of proceeds? So it really depends on the client's situation, which one they would like to use. If we look at our platform and to answer the question that those people have, which endowment should I use? About 90% of the time, advisors do choose the life insurance bond as the preferred option to use. One other important thing that I'd just like to mention is we talked about the liquidity and the 100 policies underneath. All withdrawals a client makes from our endowments are loaded as interest-free loans. Why is this important? Because if a client later on in the investment journey would like to add money into the endowment and they have taken a withdrawal, there will be a loan. So that ad hoc or additional investment they make will first go towards repayment of the loan, and thereafter the contribution, if there is, would go to the calculation of 120 for the 120% rule. Now this is quite important because I know not all product providers necessarily have structured their endowments in that manner.
So essentially, best of both worlds. You can solve for liquidity while you still have the tax efficiency of the endowment structure.
100%.
So tying it back to, what is obvious for me is you're looking for a product provider that has got flexibility in their product offering. I want to just get your view on one thing. So the product offering is one thing, but it's only one part of it. What can you tell us about the specific investment components that you can access in either the international investment option or the international endowment option? Is that important?
That's very important. The main reason is because these products won't generate you a return. At the end of the day, you'll use the product as a mechanism to invest, but you still have to choose underlying investment components. And I think this is once again where Momentum Wealth International is so powerful, because we have such a wide choice for the investor and the advisor. Obviously, financial needs are different, so therefore we try and cater with different unit trust funds on the platform. So in different categories, different currencies, global fund managers right around the world. So a lot of unit trust funds to choose from. But further to that, clients can also have international share portfolios through the platform, various custodians to choose from.
So let me maybe pause. How many funds are there exactly available on MWI? Is that something you want to touch on?
1,000 plus. I think
Yes.
it's important to bear in mind not all of them are FSCA approved, and advisors need to look at FSCA approved funds. But we've got a lot. We have in excess of 1,000. I think we are one of the platforms with the widest choices. At last looking at ETFs, exchange traded funds, we were, I think, standing at 82 different ETFs, which is quite a lot.
Thanks, Hannes. Marius, so what it does show is flexibility and choice. So you've touched on personal share portfolios, we've touched on unit trusts, we've touched on ETFs. Can you access all of them in the same contract, or is it essential that you take out separate investment contracts to access these components that you touched on?
So very importantly on our platform, I think the power of our platform is that you can split fund. And you can split fund in the sense that you can have unit trust funds. So you can have one endowment contract, for example, with a choice of unit trust funds. You can have listed ETFs as a choice for your passive investment components. And you can have, for example, two custodians or two personal share portfolio providers.
With different providers.
Managing that in one contract, which is quite important. You do not have to have an endowment for this PSP provider and an endowment for this PSP provider. So a lot of power in terms of, sort of applying your asset allocation across various components all in one contract. And also important is financial advisors that use DFMs or model portfolios. It's important to know that those DFMs can also include in their models not only unit trusts, but these listed ETFs, which is a great value add for them. And it also, of course, passive management brings down the TERs in these portfolios. So very powerful from a DFM capability point of view, but also for a financial advisor to split fund within one contract.
Hannes, we've briefly touched on unit trust. Now I know that they come in two flavors, accumulating funds and distributing funds. For me, it sounds like a financial buffet. Can you dish out the tax consequences and please touch on what the differences are between those two?
Certainly, Francois. So I think it's important to start off with what we know. We are familiar with South African unit trusts, where if there's an income distribution or a dividend, that is declared, and often on a platform, or if you are invested with an investment manager, that cash is used to buy units again. So you don't see the cash, but it's being absorbed back into the portfolio, back into your fund, back into your investment, but you are still obliged to pay tax on that. It's still part of your tax liability. Internationally, we see the so-called roll-up or accumulating funds. And in these funds, the income is not declared. It is absorbed inside the portfolio. It means that from a tax point of view, you are not faced with an income tax event. You are only looking at paying CGT when you switch or liquidate the fund, and that might be sometime in future. And at that time, it will in all probability be at a lower rate than your income tax rate.
It's a huge benefit.
Yeah, it's a huge benefit, because what you are achieving is you are not only achieving a tax arbitrage, lower rate, you're also postponing the tax event to a later date. And as all financial planners knows, tax postponed is tax saved. Bear in mind, certain jurisdictions have caught onto this, and if you are invested in accumulating funds, you need to make certain declarations to the tax authority. An example would be a UK taxpayer who will have to make additional declarations in his or her tax reporting, and this is where the term reporting funds, UK reporting funds, comes in.
Okay.
So it's a specific type of rules that those funds comply with. Let's take again the UK example, where that information that a taxpayer, a UK taxpayer, very important to bear in mind, we are talking here about someone who's a UK taxpayer, where that person need to make those additional declarations. But if you're a South African taxpayer, accumulating funds, great way to manage your tax liability. Francois?
Yeah, Hannes, good summary, thanks. So essentially, what do we know thus far? We know that if you are looking to cater for the needs of ever-evolving clients and ever-evolving financial industry, Momentum Wealth International is the place to be. We've got the right product set, we've got flexibility, we have got options. We've quickly touched on the tax consequences for some of the funds, Marius, next question to you. What should advisors look out for when advising a client on either one of these two products?
Sure, that's a good one. It's probably the most important thing. So I always say to the financial advisor, start with the end in mind. And what do I mean with that? I would like to sort of teach them to think of the two categories that is in play in an investment. And what I mean is that you have a financial advisor that advises a certain client. And that client obviously is resident somewhere and pays tax in a certain jurisdiction. So for example, you've got a SA client that pays tax in South Africa. So that's one part of the equation. Second part of the equation is we're always thinking about estate planning, and we're thinking along the lines then of what does the beneficiary look like? Where's the beneficiary a taxpayer and where's the beneficiary a resident? Those two things are quite important, because if a client, for example, is majority of the time a South African taxpayer and resident, and for example, they're in the higher tax brackets, they will tend to lean towards the endowment product. Once they're in this endowment product, they would have chosen it potentially for the tax benefits while they invested, maybe the structure in terms of single ownership or joint ownership. But then the next, thing that they need to solve for is the beneficiary. Now, once again, this flexibility is quite important, because you might have this SA investor that has a UK beneficiary. So the UK beneficiary being a UK resident, for example, paying tax in the UK. Now, if you're limited by product where you only have a choice to nominate beneficiary of ownerships, like a sinking fund, for example, that might not be the optimal solution. So you have this scenario where you have to have flexibility, because what you might end up wanting to do is to say, SA investor nominating a beneficiary of proceeds in the UK. But things will change where the beneficiary of proceeds, or that UK investor, moves to South Africa later. And then you want the flexibility to change them from a beneficiary of proceeds, for example, to a beneficiary of ownership. So it's always important to look at those two aspects and look at the flexibility in terms of the nominations that you do. And I think once you solve for those two things, I think you're pretty much 90% there in terms of the structure that you would look to put in place.
What I want you to quickly unpack for us is the difference between beneficiary of ownership and beneficiary of proceeds.
Sure.
You touched on that. If you can just give us a...
Yeah. So when you become a beneficiary of ownership, it means that you take over the contract, and when you're a beneficiary of proceeds, the contract ends and the cash pays out. That's important potentially because in certain jurisdictions, you do not want to take ownership of it, because you could place yourself or the owner in a situation where they're paying tax within the endowment and in that jurisdiction. So it might be more beneficial to get the proceeds and do your own investment from there on in.
So that covers succession planning and what we call the international endowment option. What I'd like you to touch on next is, let's touch on the international investment option, our LISP product, as you referred to it. But then three words that I've heard come up more and more: grant of probate. What was our treatment in the past, and how has that treatment changed currently? Do you want to touch on that?
Francois, I'm gonna steal the limelight for that one. So I think it's important, if we look on the slide on screen, we can see how there's different planning opportunities when you have a voluntary investment. So first thing to remember, MWI, Momentum Wealth International, is a Guernsey-based company with a Guernsey-based nominee, or a nominee not based in South Africa. It means that we can allow for multiple owners on our voluntary product.
You're referring to the nominee company?
Well, that's an additional benefit if you want to sanitize your investment as much as possible from the South African jurisdiction. So there are many reasons why we can have multiple owners on our IIO. And I think the important thing for clients is to understand how they can use this product to their benefit. So an example, let's take a simple example, mum and dad. So if mum and dad were to be the co-owners on this international investment option, and let's say dad dies, the benefit is that it's fairly simple for mum to become the owner of this product. Section 4Q of the Estate Duty Act means there's no estate duty The ACE schedule to the Income Tax Act means that there's a rollover of the CGT. It's a fairly simple and quick, easy process to transfer this investment into the surviving spouse's name. It's quick and easy. Not the same amount of paperwork that you have with a winding up process. So it means that if there's a need for cash to supply the surviving spouse with means of income after death of the first spouse, this is quite a useful product. That spouse, mom can even go and add new co-owners to the product, but it's important to understand that that might be a donations tax, or will in all probability be a donations tax event in South Africa. So again, important to understand what the tax consequences of products are. I don't know if we should talk about what happens if mum dies.
Yeah, can you briefly touch on it? I think it is important for today's discussion.
So in the past, we required a letter of probate. Those three ugly words you've mentioned just now. But we have relaxed our procedures with regards to probate in the recent months. And if that international investment must be paid to South Africa, we will allow that investment to be paid into the estate account. Very important, the estate account as created in terms of the local winding up process. If the policy is worth less than 25,000, or the product, not the policy, if it's worth less than 25,000 USD, we will allow for this product to be transferred to a beneficiary who might be in another jurisdiction, or to pay out to that beneficiary. If it is worth more than 25,000 USD, we will still require the probate process. In other words, appointment of an attorney, executor in the Guernsey jurisdiction, who will liaise with us to have this product transferred to the ultimate beneficiaries. For that purpose, you don't need an offshore will, but it's often useful to have an offshore will, single asset offshore will, if you only want this one asset to be handled by your offshore executor. As we always say, don't be scared of probate, just be prepared. Francois?
Thanks for clarifying, Hannes. In true game show style, I would like to ask for your final concluding remarks.
I'll go first. I think the important thing that we try to convey today is have flexibility in your product choice, have the option to change product choices and structuring options, and from an investment component point of view, have a product provider that offers a lot of investment components that can all be split fund with one investment, so you can asset allocate according to what you want to achieve.
Options and flexibility is key.
Correct.
Thank you. Hannes?
Francois, I suppose the audience will shrug their shoulders in irritation when I use the metaphor of life happens. It's a cliched statement, but it's becoming very important when we are looking at international financial planning. People who have never considered immigration suddenly decides, I want to immigrate. It's important, that flexibility that both of you mentioned, that the product you select will make provision for that. And then the second point where I started also, multi-jurisdictional product planning. That's important. Does your product provide for not only the South African scenarios, but also for offshore scenarios? And I think, as we mentioned today, our products give you planning opportunities for multi-jurisdictions. It gives you choice, the wide choice that you've discussed, and the fact that ultimately our product can change at the drop of a hat.
And I think that is important. So what we are leaving our guests with are two things. Firstly, double check your tax returns. That is clear. But secondly, and probably most important, Momentum Wealth International has got all the options, all the flexibility to cater for an evolving client need, evolving financial advice landscape. Gentlemen, thank you for your time.
Thanks, Francois.
Thank you, Francois.
I'd like to thank each of our speakers for their contribution to today's discussion, and so too our advisors for your attendance. Thanks to all of our speakers and you, our engaged audience. I'm looking forward to our next session. Same time, same place, same tax laws, hopefully. Thank you.